Okay, one more little video handout here. Looks like we're going to start off with a couple of true-false questions. It says here, the balance in the accumulated depreciation account is the sum of the depreciation expense recorded in past periods. And for our purposes, we have to determine, is this true or false? Okay. For our purposes, the answer here is true. Okay, so if we think about a journal entry, we would record depreciation expense, and then essentially our credit would be accumulated depreciation. So let's say that we have depreciation expense for $500 on something. This would be our journal entry. Now, what I want to point out is that depreciation expense, this $500 in depreciation expense, is going to go over to the income statement, and it's going to be a $500 reduction to net income. It's going to be added to the expenses just like rent expense, wage expense, utilities expense, whatever. Okay? However, this accumulated depreciation, it says, what do we think of when we say something has accumulated? It's been added and added and added and added. Okay? So this accumulated depreciation is all of the depreciation for past periods accumulated into one figure. So we might record $500 today, but if we already had accumulated depreciation before today of, say, $2,000, now we have $2,500. Okay, so this is absolutely a correct statement. I just wanted to kind of show you the journal entry and to understand that this is true for accumulated depreciation, but depreciation expense itself is only counted for the current period, say January 1 through December 31. Then it resets to 0, and then we record depreciation expense again in the next year. All right. It says a company depreciates its equipment $500 a year. The adjusting entry on December 31st is a debit to depreciation expense, $500, and a credit to equipment, $500. I really, really hope you got this one right, at least in your head. If you worked ahead before and you got it wrong, that's okay. But I hope you know that this is a false statement. Okay? And if you don't believe me, all we have to do is look right up here at our journal entry. We find that the first part of this is true. A debit to depreciation expense for $500. No accident that I used the exact same figure up here for an example. But here's where we have a problem. And a credit to equipment for $500. That's not how we do it. Let's say this equipment costs $2,500. That equipment is going to show up on the balance sheet for $2,500. Okay? But then we're also going to show accumulated depreciation as a credit amount of $500. And then the net asset value or the net equipment value will be $2,000. But if we were to think about this, what we're going to show on our balance sheet, for example, is we're going to show the equipment. What did I say, $2,500? Yeah. And let's just say that we've never depreciated this equipment before, and so this is the first time that we have depreciated it. Now, I want you to understand this is not a journal entry that we're making right now. And then our net equipment is going to be $2,000. Net equipment is what that says if you can read it. But the equipment is actually still going to be on the balance sheet for $2,500. Even if we keep this particular equipment for 50 years and we never get rid of it, and we use it sparingly in the business, and it's it has a resale value of $50. It's going to be on the balance sheet for $2,500. Now, If we kept it for 50 years, the accumulated depreciation on it would also be $2,500, and so it's going to have a net asset value of 0. I just want you to understand that the equipment itself we don't ever touch, whether it's equipment, machinery, buildings, any type of asset, office furniture, whatever the case may be. It's on the balance sheet at its original price, and we use the contra account, accumulated depreciation, to adjust down to net equipment or net assets. Net property, plant, and equipment would be a better way to put that. All right. The net book value of a fixed asset is determined by the original cost. The original cost right here, $2,500, less accumulated depreciation, which is exactly what we have going on right here. So A is going to be our answer. If you don't understand that, feel free to email me. But this video is getting long and we have a fairly drawn out problem coming up next, so I kind of wanted to move on. Okay, so with this JJJ Consulting started business on January the 1st. The following are the account balances at the end of the first month of business before adjusting entries were recorded. So these balances here will constitute the unadjusted trial balance. That's what we're looking at here. We looked at unadjusted trial balances in the previous chapter. Then we have some adjustments that need to be made. 1, 2, 3, 4 of them. What do they want us to do? They want us to prepare the required adjusting entries, adding accounts as needed, and then we're going to prepare an adjusted trial balance for JJJ Consulting. I want to come back up here. I said this is basically an unadjusted trial balance. These are the figures for an unadjusted trial balance, but all these accounts are completely in the wrong order, okay, and they're doing that on purpose. So, first thing it wants us to do is prepare required adjusting entries. Well, how do we know what we need to do? We're going to look right here. It says supplies on hand at the end of the month, $200. Okay? Well, if we look right up here, it says that supplies are $800. So what does that tell us? If we had $800 and we still have $200, that means we used $600. So we need to make an adjusting journal entry to show that we have used $600 of supplies. So our first journal entry is just going to be supplies expense for $600. These are all pretty basic journal entries. And then we're going to actually credit the supplies account. Now we already have supplies up here, but I'm going to put a little asterisk by supplies expense because that's a new account. We're just adding it for the first time. I'm also going to trace over this, try to make it a little bit darker. Okay, so that's our first entry. Now notice I don't have a journal entry explanation. I don't have the date. Now the date would be, let's see here, that would be for all of these. It would be January 31st. Okay, so that's our first entry. Also on January the 31st, if we look up here, right here, it says unbilled consulting revenue. So what we're talking about here is revenue that we have earned, but we have not recorded it, and if we haven't recorded it, we haven't billed it. Okay, so what we're going to do is we're going to set up an account receivable for that money, and that is $700. Okay, so we have an account receivable for $700, and we're going to call that, looks like up here we have accounts receivable, so that's not going to be a new account. And then we also have consulting revenue. Okay, so consult revenue of $700. Asset went up with a debit, consulting revenue went up with a credit. Okay, I'm going to move right over here, January 31st. The third item, rent expense for the month is $1,000. Okay, so if it is an expense, we're going to use a debit. Okay, rent expense. And what we have to see here is, are we paying cash? I don't think we are, because we have an asset called prepaid rent. Okay, of $4,000, but we're going to reduce that down by $1,000. Okay, so right now this prepaid rent has a debit balance of $4,000. Once we execute this journal entry, it's no longer going to be at 4,000, is it? It's going to be less, it's going to be 3,000. We'll get to that in a moment. January 31, what's the last thing? Depreciation on equipment, $90. Okay, this is a depreciation expense for $90, and we're going to credit, just like we did up above, the account accumulated depreciation. Now let's see here. I kind of forgot what I meant to do. I want to put an asterisk by the rent expense. And let's see here. I need to put an asterisk by depreciation expense. And I need to put an asterisk by accumulated depreciation. Now what those asterisks represent are these are new accounts that are not up here on before the adjusting entries. Okay, so these are going to be added, 1, 2, 3, 4 of them. The other thing that we need to do is we need to adjust some balances. So supplies went down by $600, so our new balance is $200. Let me write that again. That's not very bright. $200. Okay. Let's see what else happened. Supplies expense, we're going to show that as $600. Accounts receivable went up. And let's see, what was it before? It was $750. If we add $700 to the $750, it's now $1,450. Consulting revenue is also going to go up. Let's bring our calculator over here so you know where I got these numbers. Consulting revenue was $49.25 for all of the revenue that they recorded before the adjusting entries, and then we're just going to add that same $700 to it, and that gives us $56.25. $56.25. Rent expense, we'll put that on there, $1,000. Prepaid rent went down by $1,000, giving us $3,000. And then we're going to have to add both depreciation expense and accumulated depreciation. Okay, very good. So we're going to do this in good form, and I'm just going to check off these accounts as we go. So we didn't do anything with cash. So cash has a debit balance of $6,300. Hopefully I'll have enough room here. And I'm going to put a little X by that. Accounts receivable would be our next item. And it's going to have a debit balance of $1,450. Put a little X by that. Let's see here. Prepaid rent will be our next item because it is a current asset. Prepaid rent. And if I miss anything and I get these out of order, I'm probably just going to tell you and move on because I haven't really looked at this too carefully. Okay. Yeah, probably, and then probably should have put supplies before that, but that's okay. Supplies, 200. Mark that off. What else do we have? We've got equipment. Okay, so these 4 items are our 4 current assets. Then we would have equipment. And then how much is that? 7,000. Okay. All right. So let's see here. Where is that? Put an X by that. All right. So let's see. We have covered all of our. Let's see. We got a liability, income statement, equity, income statement. Okay. Just make sure we get all of this done correctly. We also need to get this accumulated depreciation in. This is the contra asset to equipment. And that's, I'm going to put that over here as a credit for the $90, okay? So we got that taken care of. Now we've got accounts payable. We didn't do anything with accounts payable. And that was $300, and I'm putting it to the right because it has a credit balance. Okay, let's see, we did prepaid rent, we've got supplies, just double checking everything. Okay, so now what we want to do is we want to go and get our equity accounts next, because we're moving through the balance sheet. Common stock is $15,000. Dividends are next, and they are $13.75. That will be a debit. Okay. Then we're going to go to our revenue accounts. We've only got one, I think. Yes, consulting revenue. I'm just going to put revenue. And how much was that? $56.25. Now remember, that would be a credit. $56.25. So we're going to put an X on that. And then we're going to have to do our expenses, and we'll just do these in order of how big they are. $1,000 for rent. Oh boy, I'm going to have just enough room, looks like. Rent expense, I'm sorry, supplies expense, $600. And then we have depreciation expense. Wish I would have written a little bit smaller. Okay. All right, so I've got all of these items here. And so what I'm going to do, and hopefully I did this correctly. If not, that's a real bummer. I'm going to add up all of my debits. Okay, $6,300, I'm over here. Plus $1,450 for accounts receivable. Plus $3,000 for prepaid rent. Plus $200 for supplies. Plus $7,000 for equipment, plus $13.75 for dividends, plus $1,000 for rent expense, plus $600 for supplies expense, plus $90 for depreciation expense, and that gives me a total debits of $21,015. So I'm going to clear this out, and then I'm going to go over here to my credit side. I didn't label it, but left is debit, right is credit. So let's see here, 90 for the accumulated depreciation, plus 300 for accounts payable, plus 15,000 for common stock, plus 5625 for revenue. And fortunately, didn't make any mistakes. And so 21015 is the total amount of all of our debits and the total amount of our credits. Again, in the interest of time and space, we don't have all of our headings and everything, but this would be the correct order. Current assets, followed by long-term assets, followed by accumulated depreciation, the contra account to long-term assets. Then we had one liability, accounts payable. We had common stock, and then dividends for our equity. Then we move into the income statements. We had one revenue of 5625, and then we had three expenses, and you see those there. Okay, let's wrap this video up. If you have any questions, do email me.